take on that risk. So when you have a robust ecosystem, which is the industry word of the day, of the year, the bank is willing to take on that risk. That doesn't affect the issuer directly, unless people say, I'm not going to make markets in your product anymore. We're still willing to make markets in the product. We just have to widen and take on that risk. So as long as the ecosystem is robust and people will take that risk. Another curious thing, and again, you stumble into these things even in developed markets, was in the case of BP. A few years ago, they had the accident in the Gulf of Mexico, and as that whole play developed, they did something that we hadn't seen ever in my career. They did not pay a dividend that had gone X. Now, I think in the US market and in the London market, certainly ex-dividends and dividend processing, cash dividend processing is something that's very straightforward. This was very strange. The dividend had gone X, it hadn't been paid yet. And the company said, okay, we're not paying that dividend. That had repercussions across a variety of products, not just ETFs, because, for example, derivatives had already expired that had included the dividend in them, but the payment hadn't come. So people had priced things and things had expired that accounted for that money that never came. ETFs had similar issues because they had reinvested money that they assumed was coming in that never came in, or in the case of total return, ETFs like reflected total return indices. It created a big mess. It can happen in developed markets. It can happen in emerging markets. Getting the structure right is important, but having the robust ecosystem of the index provider, the ETF manager, the banks that provide liquidity, and just a different settlement and clearing operations people to say, okay, this has happened. What's the right behavior for the bank? What's the right behavior for all the players to make sure that the end client is protected, the liquidity providers are protected, and just the overall reputation of the asset manager is protected. All those things came into play, and we've been able to slowly solve those problems as they come up. I think in a case of Qatar, where you have a different kind of market rules and new products coming in and new structures coming in, it'll take some time, but it'll be important to get it right.
Nick, may I add a couple of points? I mean, just within the context of the region, I think the failure that erupted from the UAE and in Saudi Arabia was lack of investor education and lack of participation by the stock exchanges locally to support the ETF. And thankfully, that's not happening in Qatar. But I think that was the main. I mean, I was in the UAE at the time, and nobody heard about I think it was the National Bank of Abu Dhabi one. And we sat down with Nasdaq Dubai, and they said, we're going to do this, and these are the market makers. And I said, but where's the investor education? Well, we don't have one. Well, we're only going to have 2 market makers. Well, how are you going to sell this? What's the afterlife, you know? And I think having a broader based relationship with the broker-dealer community, plus some of the institutional asset managers in the region, will make this product more appealing. I mean, it has to have an afterlife. You can seed it, but eventually it will die, or whether if it doesn't have a wider appeal. So investor education is a must preceding the launching of any ETF and continuing along the way, because there will be some people that will be apprehensive in the beginning. But once they understand the operational issues, once they understand the investment opportunity issues, once they understand the cost effectiveness of these ETFs, you know, they'll probably buy into it in some jump.
We talked about investor education being important. What about timing of actually creating an ETF? There was an excellent example, a headline recently, where GlobalX had launched this single country Pakistan ETF. Very next day, China announced a $46 billion economic corridor between China and Pakistan. And you can imagine the GlobalX executive just, with glee. It may have been just a fortunate example, but how important is it to attract assets whilst the underlying is hot? I think of another example, the Indian bond market. A couple of years ago, this market was hot. The world was yield starved.
Hot in front of the regulators.
But my only point is the assets that are being attracted to that market in 2 years, $10 billion. How quickly do we need to move with these domestic ETFs?
I think timing is important, but it's not the most important issue. Akbar mentioned earlier on about the MSCI. Are we late? Potentially, but we can't look back. I think it's got to boil down to evaluations at the end of the day. I mean, when somebody looks at the S&P or the FTSE or the CAC or the MSCI in China or India, they typically would look at what's the PE, what's the dividend yield, of the overall index. Okay, and that's going to be the actual driver at the end of the day. I mean, some of the sovereign wealth funds, for example, that I speak of in the region, actively use ETFs to hedge against active managers. They don't want to interfere with the investment style of the portfolio manager, but they've told me that we actually sometimes have a contrarian view to him, but we won't tell him that we have a contrarian view to him, because we want to actually apply certain market timings, let's call it that way. From retail or high net worth investors, they'll probably look at sort of what's the overall dividend yield or the PE of the index relative to, let's say, another index. For example, let's say the US versus Canada, NASDAQ versus the spiders, and that's going to be sort of more important in the long run. But it helps to have some sort of catalyst that will give it a lift. Sure.
I think it's. I echo his comments. I think it's helpful for short-term marketing, for there to be some interesting headlines which support your case, which sort of are come externally. But it's two different types of investors. The short-term investor who is a day trader or invests for a week or 3 days or 2 weeks couldn't care less about the headlines. They're just going to get in and get out and do what they do. The long-term investor isn't interested in a short-term headline either. Yes, the example of Pakistan is an interesting one because that's probably a 10-year commitment, so it maybe make people relook at Pakistan as an investment case. But the investor who's, if it's a sovereign wealth fund or a pension fund or an endowment, who takes a 3 to 5 year view, if they use the ETF as part of a strategic investment allocation, the headline is just one small part, and as Fahmy said, in the fundamental outlook of the market. In Qatar, given that we have a pretty big headline, which is currently 7 years away, I think we're okay.
Okay, so Qatar's a long-term play, but otherwise timing is everything. Emily, you said you cover the region for your clients. Why would a Qatari investor include ETFs in their investment decision making?
Yeah, absolutely. I would say we see institutional investors using ETFs in all sorts of different ways, and it just depends on kind of what their profile is. We see obviously a shift towards passive, and as investors start to look at passive, ETFs are an obvious instrument that they'll begin to look at. From a cost perspective, ETFs do tend to look attractive. As Andreas was speaking to earlier, this idea of total cost of ownership, I think it would be fair to say it's still an education process, even on the cost side of things. And at BlackRock, we obviously have other instruments other than ETFs that investors look at as well. So I think we see investors mostly use ETFs for really their intraday trading kind of liquidity. I think even investors who are using these as a long-term instrument still like the fact that if they decide to get out in a day, they can. If they need to raise cash, they do that as well. If they have, perhaps a large allocation to a market, they might only hold part of that allocation in an ETF as well. So I think there are lots of different reasons that investors use ETFs. Transparency, again, is one of them that has become more and more important over the last few years. If you're holding an ETF, you can go on the website every day and access all of the holdings, people like that as well. So I think investors use them in a variety of different ways. The themes that we see most important to them would be the cost, the intraday trading, and the transparency.
Okay. The intraday trading, just going back to the Qatar model, in your experience, when you look at it, do you see the long-term play that the asset managers were talking about here, or do you see ETFs being used for intraday trading, for speculation?
I think, again, it depends on the product, and for a product to be successful in the market, I think you need to have investors who want to use the ETF for both. There are products, certainly, in the US, I know that there are a lot of these leverage products, the 3 times leverage products. I think I heard a statistic that the average holding period for those products is 15 minutes. So clearly there are products that are designed to be more trading tools than kind of long-term investments. We don't necessarily have any of those, and I think if you look at the providers that have been most successful globally, they do build these products that are really core building blocks for investors' portfolios. And again, the majority of investors in those aren't trading those on a day-to-day basis, but of course they know they can get out if they need to, or get into the market actually as well if they need to. Obviously, news comes out and people want to take exposure immediately. ETFs offer a convenient way to do that.
Jorge, when we were talking earlier, you had some comments on this one?
One of the things that I've seen in the last few years trading ETFs and then moving to Europe to run the product is the comparison with the US market. And a lot of people say, oh, very excited about the growth of ETFs because look at how big they are in the US. And I think one of the things that we don't look at enough is the makeup of that money in the US and why the growth is so big. And part of it is customer and investor behavior. So you do have institutional money, you do have retail money in the US, but you also have a dynamic of self-directed pensions in the US that I've not really seen in Europe yet. So you have a lot of money in the US to begin with because it's a much broader market, much bigger investor base. But then a lot of those investors are running their own pension money rather than waiting for a government pension scheme to kick in at a certain age, as you do in certain parts of Europe. The fact is you're managing your own savings, and ETFs become a very easy and efficient way for you to do that, either to move in to different themes because there's a wide choice of them, or to simply do it in a cheaper, more efficient way than giving your money to a mutual fund or to another type of active manager that maybe your retirement account doesn't have access to, or your investment profile doesn't allow you to invest in futures or something like that. So that is a big component. It's a big pile of money, effectively, in the U.S. that doesn't really necessarily exist in Europe. So to compare the growth and to compare the amounts, to say, well, this money doesn't exist in Europe, so you're never going to quite get there. It'll grow, and it certainly has grown, but the trajectory may not be the same. For the Middle East, I don't know the vagaries of the market, but certainly to look at to one of Andres' slides that had the amount of available money versus what's committed to ETFs and the different ratios between the Middle East, Europe, and the US, we have to think really what is an ETF, and this is part of the education, what is and what it is not. But when you look at it at the industry level, what it is not is an asset class. What it is, it's a vehicle. So to say there's a lot more money or 6 times more money committed to ETFs relative to the size of the wallet in the US, you also have to factor in how many different products are there and how many different themes and countries and indices are represented by that ETF, the ETF market in the US. Some of that money is coming into the Middle East via Middle Eastern themed ETFs or Middle Eastern index ETFs. That is money that comes into the Qatar Stock Exchange or Dubai, NASDAQ, because the manager has to replicate locally, even though the ETF is listed away. So to try and figure out what the right ratio is for size of investor wallet versus the money that's committed to ETFs, you also have to factor in how many different kinds of ETFs are there. So would a locally listed S&P ETF gather assets here? Possibly there's some tax inefficiencies, but it all depends on investor access and the needs of the local investors to take advantage of the one big positive of ETFs, which is efficiency, cost efficiency, access efficiency. So when I tried to trade my first ETF personally, way back in 1996, it was because I wanted exposure to the S&P 500. I didn't want to bother with ordering a prospectus by the mail and getting it back and then sending an account information, and a few days later getting the end-of-day fill on my mutual fund trade. I couldn't trade S&P 500 futures either because I didn't have the right investor profile or the money, frankly. And ETF was easy enough. It was, well, I don't know if we can speak about tickers, but everyone probably knows what the big S&P ETF in the US is. And I remember I called my broker. He's like, what is that? I have no idea what that was, but it was the right nominal amount, and it was easy for me to trade. So locally, do clients need access like that and then for what products? Is it for local index products, which I think is the first step, and that can succeed, and that I think can expand the overall market in a very positive way.
But I think, probably just to add to some of the points that you mentioned, eventually, I think probably the single most biggest contributor to the Qatari ETFs will be foreigners over time. The World Cup's happening. Hopefully, we'll list a few ETFs, before the World Cup. So somebody sitting in Florida, he's in Miami, he's sitting on the beach, saying, "Oh my God, this is happening. What am I going to do?" He doesn't know whether I should buy Masaf al-Rayan or QNB or Q10 or whatever. I'll buy an ETF, and that is going to be probably the biggest attractive factor for foreigners coming in, and it will attract FDI into Qatar beyond what we can see right now. Yes, we need the domestic pool, but eventually that domestic pool will come to a plateau, but it's the international pool that will come into Qatar that will attract money into Qatar.
And I think that's part of getting the operations correct, because if you get the operational, the trading environment locally correct, then a foreign listed ETF on the underlying market can have a very dramatic and, again, positive impact on the local liquidity